Every index but the Russell is positive as we head into the last 10 minutes here. Let's bring in our Schwab Big Picture panel. Joe Mazzola is Director of Trading and Education, Charles Schwab, and Kevin Gorns, a Senior Investment Strategist. Afternoon, guys. Good to see you, team. Joe, I'm looking at some of the notes you got on technicals. I want to start there because we just mentioned Apple trading above the October high. If the NASDAQ were to do that, if the S&P were to do that, that seems to me like it'd be a pretty big deal.
It would be, as long as you get a nice breath thrust with that as well, too. I think, we're starting to build a little bit of momentum below the surface. We started to see kind of a rotation, and a lot of the different sectors are participating. Just kind of look at 5-day performance in terms of, what sectors are leading. IT, communication services, and then discretionaries as well, too. But you're also starting to see some of the laggards from before, real estate, utilities, financial. So they're picking up a little bit. We still only have about 45% of the S&P 500 above its 50-day moving average, but it's improving. And I think if you look at maybe even a shorter-term indicator, I'm looking at the 10-day moving average right now in the S&P 500. You got 83% of the components above that. So what that tells me is that, yes, we've had a 6% move in the last week. It's kind of picked up a lot of the components with it. I think the next test is getting up above 4,400, 4,450 or so in the S&P 500 and carrying that forward just to make sure that we get some of that momentum. Maybe the Santa Claus rally started a little bit early, but you get 6% in a week, and this is what's going to happen.
Yeah, how did those internals look? Nice description, Joe. Kevin, chime in on some of the styles and factors, what role they've played in the strength of the past 10 days.
Well, I mean, it was a rising tide lifting basically everything in the last week. And I think what you want to look for now, the past couple of days, particularly because, breadth yesterday and today is pretty weak. It's pretty anemic. And, I would have expected maybe a little bit more of a carry through, even if you didn't repeat the percentage gain that you had last week for the broader market. But yeah, if you move down the cap scale, especially into small caps, you mentioned it at the beginning of the show or the segment, Oliver, with the Russell 2000 giving back some of its gains both yesterday and today. And that's an area I'd put a lot more focus on, but also is sort of part and parcel of the environment that we're in right now, which is just, you have to focus on areas of the market that have kind of a shield against what is a high interest or a high and rising sort of tide of interest rates. So interest coverage ratios, if they're higher, you tend to do better. That's why sectors like energy, even if it hasn't done as well over the past few weeks, you look at that underlying profile and the percentage of members that are above their 50 or their 200-day moving average, and it still looks pretty healthy. It's still a robust picture under the surface. So that, to me, is more of the play when you're looking at factors who can withstand this pressure from interest rates, not just in the near term, but what is expected to be, a higher for longer environment moving into the next year.
Okay. So that higher for longer environment, though, right now it seems we continue to build consensus around no more higher. Joe, it's just we're in the longer part now. Odds of a hike this year are quickly dissipating.
They're quickly dissipating, and then the odds of a cut next year, which I think might be a little bit optimistic. They're putting that around a potential for a May or June cut. And then if you look at the calendar year this year, as you were mentioning, Oliver, December's down to about 10 or 15% likelihood of a raise. So they're pretty much pricing out cuts from now on, I think. And like I said, I think that's probably a fair trade. What I'm a little bit less optimistic on is what the street assumes to be cuts in May or June. My only thought on that is be careful what you wish for, because I think the only thing that would precede that might be a recession or some type of sharp pullback. In terms of the economy. That would be maybe the impetus or the catalyst to start that. But I think otherwise the Fed is comfortable letting rates stay at these levels for longer than what the street thinks.
Kevin, right to that point, you've got a fun analysis about what history tells us happens to stocks after the end of a hike cycle. And it seems like it's somewhat of I don't know if it's a coin flip, but there's some pretty opposing extremes in the outcomes. Is that right?
Yeah, I mean, it pretty much is a coin flip. It's as good as it gets. When you look at prior Fed tightening cycles, and all of this is under the umbrella of why we just don't think that you should be using a Fed pause or any part of the Fed tightening cycle to, base your stock analysis off of, because you can look at the past or the last hike and all the prior tightening cycles for the Fed. And, the maximum gain a year out from there is up 30% for the S&P, and the maximum drawdown is down 30%. And, I think more often than not, when you look back at that history in that analysis, the times when the market struggled more is when inflation was more of a problem. And that's obviously a little bit more subjective when you ask an investor, you ask a consumer, what rate of inflation is troublesome. You could argue now that, yeah, we've seen a lot of disinflation progress, but I would argue that from the perspective of Main Street, they're probably still reacting to what has been a pretty egregious increase in price levels, whereas on Wall Street, there's probably more of a focus on the fact that the rate of change and that second derivative change is improving. So you kind of have both of those that are a little at odds with each other, but all pushes the narrative or sort of reinforces the narrative that the Fed's probably going to keep policy tight. And, as it pertains to Fed cuts, even if, as long as inflation or disinflation continues, so you continue to see that rolling over in the inflation rate itself, as long as the Fed holds nominal rates steady, or even if they do 1 or 2 cuts next year, that still keeps real rates in restrictive territory. So I think that's much more of the focus in 2024, as opposed to, do we get a rate cut or not? It matters much more in the broader context of where real rates are.
Got it. All right. Nice. Good stuff. Love the analysis. Kevin Gordon, Joe Mazzola. Thank you very much, guys.